Welcome back to the Ile Wara Oyin podcast. Here we are back with episode number 2 of season 2, rounding up our conversation where we were talking about the price of billions, rethinking value, inflation, and human progress. So just following up on the last conversation here, we'll be reinforcing some of the same topics and adding in a little bit more color and some more examples. So in the previous episode, we explored how some of the obsessions with billion-dollar valuations often distort our understanding of value. We discussed how inflated figures can overshadow real indicators of human progress, things like access to clean water, quality education, and affordable healthcare. So today, we're going to delve deeper into how this inflationary mindset impacts the global south, particularly Africa. We'll examine real-world consequences of borrowing in inflated currencies and explore alternative models that prioritize human dignity over speculative finance. So starting off with the real cost of inflation. So in developed economies, inflation is often viewed as a technical challenge, something to be managed through fiscal policy and interest rates, as previously mentioned. But for African nations, inflation manifests in intangible hardships. So rising food prices, increased transportation costs, higher healthcare expenses, these things become daily struggles for millions of people. And when the cost of capital is globally benchmarked in inflated billions of dollars, smaller economies are forced to borrow and trade within that system. And this means investments in essential sectors, things like agriculture, energy, healthcare, they become debt traps. These are denominated in foreign currencies, and they're stripping nations of their sovereignty over value. So, borrowing in billions is paying in pain. So consider developments in Africa, like Qatar's Al Mansour Holdings has pledged $103 billion across 6 African countries, including $12 billion to Botswana. While these figures are impressive on paper, they often come with strings that are attached. Foreign currency loans, high interest rates, and terms that may not align with the host country's long-term interests. This is something that I'm seeing a lot of discussion on LinkedIn and other platforms. And I don't want to name names, but maybe in future podcasts, I'll name names and shout out some of the people that I am seeing having these discussions. But, high interest rates on loans that are taken from Western countries, but I know that we're talking about Qatar in this situation. One of the things to keep in mind that has been in some of the discussions that I have been seeing include just the fact that the folks that are involved in some of the deals, some of the bond deals and some of the deals between nations, African nations and Europe or some of the other Western countries, the parties that are involved in evaluating those deals are not always necessarily the right parties to be involved in evaluating those deals. Some of those deals are not being made by keeping in mind the long-term future of the nations. Sometimes those deals are just being evaluated by folks that will be in office for a short-term amount of time, which is okay, but they end up setting themselves up for deals that do not serve their countries in the long term. So we need to start involving the right parties in making these deals so that they can understand some of the traps or some of the doors that they're walking into, and make sure that they are fully evaluating all the implications of the deals that they are making. I'm sure that there are some models that are out there. I'm sure that there's some frameworks that are being followed. But one of the things that should be done, or that we should constantly be rethinking about, is what are the key areas that are being stress tested, or what are the key drivers that are being thought of when countries like Botswana are making $12 billion deals. Desperation, and I'm not saying that these deals have been made in desperation, but we want to make sure that desperation is moved off of the table, and that we are properly evaluating all of the deals that we enter into, so that we don't set ourselves up just to feel like we made a deal and we have money on the table today, just to find out that 50 to 100 years from now we are still suffering because of a bad deal that was made. Decisions have to be made with the long-term consequences in mind. So like I said, it can be impressive to see that, wow, we have a $12 billion deal being made between Botswana and Qatar on paper. But there's strings that come attached with deals like this, like the foreign currency loans, high interest rates, and terms that just may not align with the long-term interests. With Botswana's $12 billion deal, this is focusing on sectors like infrastructure, energy, mining, and agriculture. And oh, by the way, this maybe it doesn't happen all the time, but sometimes you see these deals happening, and you think that they would do things like create jobs for the local people. And sometimes these are not leading to jobs being made, because you'll see that the folks making the deals sometimes will bring in their own people, which doesn't help to stir up the development that we're looking for. So while these are critical areas for development, the scale of investment, it does raise questions about debt sustainability and the potential for economic dependency as well. So if we strip away all the jargon, what becomes clear in this is that humanity has lost its sense of proportion. We've allowed money to become so abstract from human need that it no longer reflects access to basic things of life that are important, like water, food, housing, and education. Inflation, in the way it denominates, or in the way that it dominates our discourse, is not just an economic concept. It's a symptom of a deeper misalignment, and we are inflating not just our currencies, but we're inflating its expectations, and we are discarding what is best for the collective well-being of humanity. So just to highlight some examples of other deals, just to ground this conversation in more reality, here are some recent billion-dollar deals. So you have, as I mentioned, the $103 billion pledge across 6 African nations with Qatar, including $12 billion of that's allocated to Botswana. For Botswana, that's a $12 billion investment deal with Qatar's Al Mansour Holdings, targeting sectors like infrastructure, energy, mining, agriculture, cybersecurity, and defense. Then you have the South African Power Pool. That's a $1.3 billion initiative to build high voltage transmission lines linking countries in the region. And while these investments are significant, they come with challenges such as debt sustainability, economic dependency, and questions about long-term benefits, like benefits for local populations. think I have a couple of other ones to highlight. So just to highlight one or two other deals for you, you have Syria's $14 billion investment, and that is in airport, subway, housing deals. And, that's urgent infrastructure rebuilding via foreign capital. You have Vodacom and the Massive deal. That's 120 million. And that's for local telecom infrastructure in South Africa. There's many deals that, if you're paying attention to recent deals in Africa and other developing nations, you'll be able to easily spot some of them. When I see these deals, these high valuation deals, it makes me question first. I don't see them and just initially celebrate. Of course, if it's going to lead to some good, then it is to be celebrated. But at the same time, when I see the high valuations, as a person working in the financial industry, my first position when I see these deals is to question why the valuations are so high and who is benefiting from those valuations being so high. That's my first thought. And I have seen a lot of these deals over the last couple of weeks, and that's been my first thought. So not all economic value needs to be not denominated in these inflated billions. We need to consider things like intra-African trade through the African Continental Free Trade Area, doing things like reducing tariffs and simplifying trade routes, African countries being able to trade with each other more directly. These things can reduce dependency on global currency fluctuation and keep value circulating within the continent. That's something that's very important. We're always looking for investment, and that is okay. But one of the things that I want to encourage is African countries doing deals with African countries, trading with African countries, looking for investment within Africa first, looking for investment within our pension funds. There are within endowments, pension funds, and etc. Looking for that investment within the continent first, empowering ourselves within the continent first before going outside. Because while it's great to get investment from foreigners, these foreign companies are also going to be taking their returns. And they're most likely, if they're not going to take that and reinvest, they're going to be facilitating capital flight. But if you have investment from African pension funds, that's going to stay within the continent. You just make it harder for money to trade hands and be taken off of the continent, because anything that doesn't stay within the continent has the risk of not leading to a better quality of life for the average African person. So regional infrastructure projects like the Southern African Power Pool, efforts to connect Angola to Namibia, and Tanzania to Zambia. These things demonstrate collaborative efforts that can enhance energy access without relying on massive foreign loans. So the big takeaway here is that inflation is not real. $1 billion deals are real. Inflation is real, but it's not necessarily born out of nature. $1 billion deals are real, but they should not be the only story. The measure of success is whether an economy can make life better for its people, whether a child has access to school, whether a farmer can sell their harvest at a fair price, whether families can afford homes, healthcare, and energy without drowning in debt. And the task that we have isn't just about controlling inflation, but it's about deflating our obsession with money as the only metric and reinflating our commitment to human life. We need to get away from greed and go back to caring about human life and human decency. Because if billions remain the baseline of value, billions of people will remain excluded. I'm Olayemi. This has been Ile Wara Oyin, episode 2 of season 2. Thank you for joining. If the conversation resonated with you, please share the conversation. Please subscribe to the podcast. Please join next time as well. And as we continue to rethink about what really matters, what truly matters, I hope this has sparked some inspiration within you. You'll continue to follow the conversations, make suggestions, and interact with the content that we are putting out. Thank you.